Hello, this is lecture 3 in a series of lectures which will be given to undergraduates starting a degree in banking and finance. The first lecture was about the roots of money and banking and just really took us through a historical sequence to try and understand the basics of money, banking and finance. Lecture 2 dealt with some of the terminology which is often misused in the subject and added some description of terms which are very important throughout this particular course and of course throughout anyone's career in banking and finance. Lecture 3 is going to concentrate on a few more theories to do with banking and finance, two of which are often confused and there's a lot of muddle. So I'm going to try and sort out the basics of these theories and explain to you how they vary. One is definitely concerned with banking and finance within banking and finance. The other is more to do with the environment, the economic environment within which banking and finance works. One's called the Money Multiplier and the other's called the Income Multiplier, and they are different, but there is enough similarities for people to become confused about the way that they are used. The Money Multiplier is not a favourite of many economists these days. I'll explain why in just a moment, but I think it is quite important to understand this and get some feeling for the subject matter and how money can multiply when certain things happen. The money multiplier is about the stock of money in the economy multiplying, the stock of money being the total supply of money in the economy, excluding the speed at which it moves around the economy. The income multiplier comes out of an explanation of the circular flow of income, and it's a measure of the money flow of income. So the money multiplier is about a stock, about almost a static number at one point in time. The other, the income multiplier, is about a flow of income over time measured in money. Now you do have to get clear in your mind the difference between real and nominal. Real always refers to output. Nominal is just units of something which measures something, in this case units of money which measure things within an economy. And the money multiplier is always nominal. At least I like to think that it is always nominal. There are some people who talk about the real money supply, and what they're talking about there is output measured in units of money. They're not actually talking about money in itself, because money in itself is just a unit of account, a medium of exchange, a store of wealth, a standard of deferred payment. The characteristics and functions of money are those. So the money multiplier I would always refer to as being nominal. So it tells you about the number of units of money that are being used to measure things, whereas the income multiplier can have nominal effects or it can have real effects. That is, what happens can just be changes in units of money which would be recorded as inflation. That's nominal. Or it could be real, it could be associated with an expansion of real output in the economy. So you could have a nominal aspect to the income multiplier or a real aspect to the income multiplier. So let us start firstly by looking at the money multiplier, and let me remind you of the definition that I think is important with regard to money, just so that we don't have any confusion here. And F.A. Walker, a long time ago, a couple of centuries ago, said money is that which passes freely from hand to hand in full payment for goods in final discharge of indebtedness, being accepted equally without reference to the character or credit of the person tendering it, and without the intention on the part of the person receiving it to consume, enjoy, or otherwise use it than by passing it on sooner or later in exchange. That's what money is. It doesn't provide you with any service as such, except that you can use it to pass on to somebody else in exchange for something that will provide you with utility, usefulness, will provide you with a service of some sort. So that's what we take money to be, and there are some important distinctions that we need to identify. If you take those two concentric circles as the money supply, they're made up of two components. In the middle you've got cash. In the outside it says credit. It's all that money that was created by bank lending. Now when you remember back to lecture 1, you remember the middle was gold and the outside was gold money receipts, which expanded as soon as goldsmiths got involved in banking. But coming right up to date, this is what money is. Money is the outside, it's the whole, the big concentric circle and everything inside it, whereas cash is just that little circle in the middle. So when people refer to money, it's cash plus credit. When you refer to just cash, it's that bit in the middle. And if you refer to cash or credit, then cash money is that money that you see in the base, in the middle there, and credit is the money that has been created over time through bank lending. Rough percentages, because these don't indicate it particularly well to you, but in the UK economy at the moment you'd be looking at about 5% of money being cash and about 95% of money being credit or money created by bank lending. Is money an asset or a debt? There are some schools of thought in economics that like to think of money as a debt, but money is no longer a debt. It is an asset, but it is not a debt. If it was a debt, then it would be an IOU. And under the gold standard, money was debt, because when you had a banker's receipt, a note for money, you could then exchange it for gold. It was backed by something. But fiat currencies are backed by nothing other than themselves. And although some economists like to think of money as debt, it isn't, because money is not an IOU. You cannot take your £5 or £10 or £20 notes and be promised, as it says on the note, to pay the bearer £5, £10 or £20. Under the gold standard it would have been that value in gold. Now they will just give you another identical note. So it isn't an IOU. But money is an asset, because if you own money, you own an asset. And all of your assets, all of your wealth is, you can add up and you can hold some of your wealth as money. So money is an asset, and I would say it is not debt. Is electronic money cash? There's a lot of talk of electronic money, particularly after the various rounds of quantitative easing, and I often feel that it was an attempt by the Bank of England to direct your attention away from the idea that they were printing money, and they called it electronic money and said that it wasn't notes and coins. But it is 100% backed, electronic money, by cash, and I'm quite happy to accept that electronic money is exactly the same as cash when that electronic money has been created by a central bank. So money created by banks with a small b is not cash, but any electronic money is exactly the same as cash if it is created by a central bank. So is electronic money cash? Yes, it is. And the Bank of England, when it tries to deflect attention away from that, is misleading you. What's the difference between currency and legal tender? Now, that's quite important, because legal tender is notes and coins, but not in multiples of notes and coins. Actually, it is in terms of multiples of notes, but it's not in terms of coins. So 50p or 20p, each individual one is legal tender. But more than £10 worth of 50p's or 20p's is not legal tender. Each 10p or 5p is legal tender, but over £5 worth of 10p or 5p coins is not legal tender. 20p is the limit for 2p and 1p coins. Anything more than 20 pence is not legal tender. The word legal tender just means that you can legally compel your the person that you owe money to accept that in full and final payment for some debt that you have with that person, or it just may be a trade with a shopkeeper, whatever. So the law, if you like, was trying to protect shopkeepers from, say, that person who had a jar full of 1p's and went in and wished to buy something for £50 and wanted to empty out all these 1 and 2p coins on the counter. The shopkeeper doesn't have to accept that, because that amount is not legal tender. So think of every unit of cash or currency as legal tender, but multiples of those currencies or cash is not legal tender. You'll also come across the reference to liquid and illiquid assets. 100% liquidity is cash. And then as you move away from cash, then you will find it possible to turn whatever it is you're thinking of into cash, but it becomes more and more difficult, so much so that there's a liquidity spectrum from very liquid assets to very illiquid assets. Cash is liquid. Your credit cards and your cheques are not quite as liquid as cash. They're almost as liquid as cash, but then you can go into things that you own that you might be able to sell easily onto somebody and get some cash for them. They're fairly liquid, and then you've got things that you own that are very illiquid. It would take a long time to realise them in cash. So your property, the house that you live in, is very illiquid but can be turned into cash, but it takes rather a long time to do it. So you need to understand all of these differences, and there is, if you go on my blog, an article about money, money supply, money creation and monetary demand, which will go through all of these items in a little greater detail should you want it. But once you've got it clear in your mind, the difference between all these things, then it's fairly easy to move on to the next stage. Now, one of the things that I like to use at the start of courses, which again is something that not lots of economists like to use, is the quantitative theory of money. I think it's very good at explaining things in a simple way, and you can build complexity into it later on in the course. But it's a fairly, Irving Fisher developed the quantitative theory of money, and it's a fairly simple equation, although some people like to say it's an identity, not an equation, and offer some confusion into the analysis. Quantitative theorists have often made themselves a little bit of a problem by rearranging the equation and introducing more variables and making it quite complex and difficult to understand. But if we go right back to the original quantity theory of money equation, then I hope you find it fairly easy, and it's fairly useful to understand what is going on in the financial sector of the economy. And the original equation was just that. It was MV equals PT, where M is a reference to the stock of money. That's the physical quantity of money in the economy. And V is the speed that it goes round. So M times V equals monetary demand. If you like, another illustration of that would be something like that. It's our cash and it's our credit which together make up the money supply, and the speed it goes round in the economy is the velocity of its circulation. So on one side of the equation you've got M and V, that's monetary demand, and on the other side you've got all prices, but the average level of prices, and T, the number of transactions. And if over a period of time you multiply average prices by the number of transactions, you'll get a total which you could equate to the national income. So more or less what you're saying is that M, the money stock, times V, the speed it goes round in the economy, will equate to the average level of prices and the number of transactions. And with no further thought you can see, okay, if this is an equation, I can juggle around any of these variables. I can increase M, lower V, and leave P and T unchanged. I can increase T, leave P unchanged, and then either V or M would go up, and some can go up, some can go down. You can play around with it all the time. But what tends to happen in the economy is the central bank controls the stock of money, M, and that often changes to try and do things within the economy, boost the economy. So M goes up, it might affect P, it might affect P and T, it might affect V. There are explanations of that we would come to later. It could be the economy expanding and growing, just number of transactions increases. So what you would want to maintain stable prices is for monetary demand to grow at the same rate as transactions, so as not to bring about a deflation, a fall in the average level of prices. So there's lots about this simple quantity theory of money equation that can help you understand and unravel what's going on in the economy. As I say, not a favourite of lots of economists, but it's something that I like to use to help us understand the economy, and we can think of M times V as just the nominal monetary demand side of the economy, and P times T is the real economy, the transactions, the number of real things transacted at all the prices that they transact, but created as an average for this particular equation. So quantity theory of money, remember that, because that's always very useful. And we will go now to try and sort out this money multiplier, which some economists like and others don't. I'll explain why they don't. This is the multiplier. It is a calculation which is just 1 over the cash ratio. And I say cash ratio in this case, there are other ratios, eligible reserve assets, that are often referred to, but in the way we're building up things, quite easy to separate cash from all the other forms of money in the economy. And 1 over the cash ratio just gives you the multiplier. If that, well, let us go back. One of the reasons why people don't like it now is because there is no official cash ratio that banks have to hold. In the past, if you go back 50 years or so, there was a cash ratio. All banks were told by the central bank in the UK that they had to hold 8% of all of their assets as cash. So these two circles here would be 8% in the middle, cash, and then outside that there would be a total which would be a multiple of that. Now 1 over 8 over 100, 8 over 100, 8% over 100% is the cash ratio. 1 over 8 over 100 would produce 12.5, which means that the outside circle would just be 12.5 times greater than the inside circle. Now that was an official ratio, and therefore economists worked with that and thought about that, and then when the central banks removed the cash ratio completely, economists tried to forget it and developed other theories which ignored this particular thing. But this particular thing is still there. Banks are still in a situation where they have to keep a certain amount of cash relative to the amount of loans that they have made, relative to the amount of assets that they're currently holding on their books. Because you and I, if we go to an ATM or we go to the bank, we want cash. So there is a demand for cash, and if banks cannot satisfy that demand for cash, then there will be a problem for them as customers lose confidence, and as happened with Northern Rock not that long ago, will start queuing up outside and wanting to take their cash out of the bank. So there is a central core to banking which is now created not by an official number, but by the number that banks think is important, the amount of cash that they've got to hold to satisfy everyday customer demand for cash, including exceptional days of demand for cash. So that is the ratio that we're talking about, the amount of cash that banks have to hold. And what the multiplier tells you is that if there is a change in the amount of cash, then that will have a multiple effect on the amount of money that can be created in the banking system. It doesn't always happen that it's created, but it can. As I said to you, if we were talking about the original 8%, it will be 1 over 8 over 100, which is, how many 8s are there in 100? 12 and a half. So you've got your multiplier of 12 and a half. Some other numbers for you, just so that you get this one quite clear. Let's think about banks which want to hold 5% of all of their assets in cash. Then the multiplier will be 1 over 5 over 100, which is 20. If they wanted to hold 10%, it would be 1 over 10 over 100, which is 10. If they wanted to hold 20% of all of their assets in cash, it would be 1 over 20 over 100, which is 5. So those would be all the multiples dependent upon the amount of cash that banks wanted to hold. And the important thing there, get this one right, if we just go back and look at this, if the multiplier turns out to be 20, what does that mean? That means that if the bit in the middle, cash, changes by 1, the outside will change by 20, which means that credit or bank loans can increase by 19. If it was a multiplier of 10, a change in the middle of 1 will increase the outside by 10, and the amount of loans that you can increase, the amount of credit will increase by 9. If it was a 20% base and the multiplier was 5, then a change of 1 in the middle would change credit or loans by 4, increasing the outside by 5. So it's a slight thing that can cause people just a little bit of a problem when they are dealing with multipliers, but hopefully that has explained it to you. And it's quite an important concept, because if you're trying to understand what is going on the money side of the economy, and you know that there's a lot of cash being injected into the economy, it should have a multiple effect. Theoretically, it will have the multiple effect described there, but of course it doesn't always work like that. But the fact is that it could work like that, depend upon what proportion of their total assets banks wish to hold in the form of cash. Now, let me bring that one back up again, just to illustrate a couple more points to you. A central bank could influence banking by changing the amount of cash in the middle. And in the past, there was something called open market operations. Well, there still is. It's sort of hidden away, but I'll explain why in a moment. Open market operations are something which central banks can do to increase or decrease the amount of cash in the centre of these two concentric circles. An open market operation is when the bank enters the market and buys government debt and puts cash into the economy, having bought that government debt. If it wanted to take cash out of the economy, it could sell that government debt back into the economy and remove the cash. So that would then, if everything worked according to plan, have a multiple effect on the economy, the money multiplier effect on the economy. That's open market operations. Quantitative easing, which you're probably more familiar with now, is the same sort of thing as an open market operation. Quantitative easing was, if you like, one side of open market operations. It was the expansionary side. So quantitative easing took place when the government, after the global financial crisis, worried about deflation, wanted to get cash quickly into the economy, and it bought up government debt and put lots of cash into the economy. That's what quantitative easing was. It was a money printing process, but again, banks didn't like to describe it in that way, and they called it things like an asset purchase scheme, one which increases electronic money but need not necessarily increase cash. But all in all, that's all quantitative easing is. It's a way of getting cash into the banking system, and it's basically a money printing exercise. There would be another side to quantitative easing which would just reverse that, which would be quantitative tightening. And quantitative tightening would be the central bank using its government securities it's bought and sell them back into the economy and remove cash. So it would be possible to have open market operations which expand and contract the amount of cash in the system, or quantitative easing and quantitative tightening that expands or contracts the amount of cash in the system. We don't have quantitative tightening. I'll explain why before the end of today's lecture. Quantitative easing is something that's not easily understood by some economists and others, and there is again another article on my blog called Understanding and Misunderstanding QE that you might find helpful if you're interested in quantitative easing and whether it's a good thing for the economy or not. Now, if you were concerned, the alternative to changing the amount of cash in the middle here is to try and change what's going on around the outside, and that you can do with interest rate policy. And the Bank of England has really been committed since the mid-1980s to an interest rate policy rather than a quantity of money policy. If you raise interest rates, you will discourage people from borrowing. If you lower interest rates, you will encourage people to borrow. So if everything worked perfectly, you could create a situation by injecting some cash through open market operations into the middle and lower interest rates, and people will go out and borrow more money. Or if you were worried that things were expanding too quickly, you could reverse the process. You could raise interest rates, and although people would want to borrow because there's enough, although banks would want to lend, people may not want to borrow because the interest rate is too high. So certainly theoretically it's nice and easy. You could think in terms of just interest rates going up and down, expanding or contracting the amount of money in the economy. But it doesn't always work like that, and it often depends upon the state of the economy. After the global financial crisis, the immediate effect of lowering interest rates was almost nothing at all. It didn't encourage bank lending, which is why QE as a technique of trying to manage monetary demand took over from what seemed to be a failed interest rate policy, lowering interest rates from bank rate 5.75 all the way down to 0.5 didn't encourage the amount of borrowing that central banks hoped it would do. So within the banking system, you've got a central bank who can try and influence the amount of money in the economy by doing one of two things. It can change the amount of cash in the economy and hope that the money multiplier effect will take effect in the economy, or it can try and manipulate the total amount of borrowing in the economy by interest rate adjustments. Interest rate adjustments and cash adjustments are both being used together now, but the favourite for the last 40 years or so has been interest rates, and it's only since the global financial crisis that we've started to really look at the amount of cash coming into the system, and indeed the pandemic now is encouraging more quantitative easing to try and offset the fall in demand which is taking place when lockdown slows the velocity of circulation of money. So hopefully you've got an idea of what the money multiplier is, and as I say, it's not generally accepted by every economist as being the clear explanation of how money works, but it is a simplistic explanation which is important in my understanding of monetary demand, and hopefully you will see it's useful and helpful in the way that you understand what's going on with money in the economy. Now, let us move just to the income multiplier, which is not too dissimilar to the money multiplier, but it is different. And there's some new terminology around that. The idea of an income multiplier was introduced along with Keynesian thinking. So Keynesians started to think about aggregate demand, the total amount of demand in the economy, and although it was aggregate monetary demand, they sort of dropped the monetary bit in the middle because Keynesians always think of money as unimportant and just an accommodating feature of managing an economy. So Keynesians introduce aggregate demand, which sort of takes the emphasis off money when they're talking about how the economy works. And Keynesians have an idea of what's called a circular flow of income. Now, it's a bit complicated to look at, I know, but you can think of the circular flow of income as all of the products going one way and money going the other way between five sort of sectors of the economy. A simple one would be to look at producers and consumers, top and bottom. There would, if there were no other sectors in the economy, producers would produce things, consumers would sell themselves to the producers as productive factors, receive incomes. With those incomes, they would buy the things that are produced by producers. So you've got a sort of self-regulating two sectors in the economy. And then you can say, well, suppose consumers didn't spend all of their money, they saved a proportion of their money. Then what happens to these balances? And you can go, well, if consumers save some money in financial markets, and in financial markets they lend money to producers to buy new machines, to develop new products, etc. You've got sort of three sectors to the economy: producers, consumers, and a financial sector. If you add government to it, you've got governments taking money out of the economy through taxation and putting it back into the economy through spending. So you've got four sectors. And if you think of one economy related to other economies in the world, you've got flows of exports to other countries and imports to this country, which make a sort of fifth sector. And remember here, when you look at the flow of the products, the flow of the income is always in the other direction. So when we sell exports abroad, the products go abroad, but the income from their sale comes back to the UK. But when we buy imports from abroad, those imports come into the UK, but the money flows out. So the idea of a circular flow of income helps build up a sort of Keynesian argument for what happens if you inject things into that flow or take things out from that flow. And there is a fairly simple withdrawals injections model, of which I give you a graphical representation of, which would look something like that. So on the vertical axis, you're just measuring units of money. On the horizontal axis, you're measuring the GDP of the economy, the national income of the economy, the real GDP of the economy, the output of the economy. And you're saying that between those two axes, there's a withdrawals function. And it's saying that as economies grow, GDP increases, national income increases. So there's an increase in the amount of withdrawals from the circular flow of income. Now, what are the withdrawals? The withdrawals are savings, taxation, and imports. They all cause money to flow out of the circular flow. And as you become richer, you buy more imports, you save more money, you pay more taxes. So there's a nice, clear, functional relationship as GDP rises, so the amount of withdrawals measured on the vertical axis increases. There are corresponding injections into the circular flow. Those corresponding injections into the circular flow, savings turns into investment. So when you save at the bank and the bank lends it to someone else, that would be a reference to investment. For taxation, the corresponding injection is spending. So when the government takes money away from you in the form of taxation, it puts money back into the economy by spending. And when you look at the withdrawal of imports, which takes income out of the economy, you can see the sale of exports will bring income back into the economy. But these three are not thought to be related to the size of real GDP. Obviously, this is very simplistic, but one illustration of that reference would be the purchase of our exports. It's not unrelated to what happens to our income. What happens to the demand for our exports is what happens to demand in other countries, not in the UK. So it's considered there's no functional relationship, but we can disaggregate that in a more complex diagram, but we won't do that here. Where these two lines cross is where you get your equilibrium level of national income or output or GDP or whatever you want to call it in the economy. And if things never changed in the economy, then you would get those flows in and out, which would cancel each other out, creating and sustaining an equilibrium YE. However, if you are a Keynesian economist, in days gone by, I hope you can see YE there, the intersection of J, the injections, and W, the withdrawals. You would get an equilibrium at that position there, but you could have unemployment. And the Keynesian economists thought of this as an output gap that they could close by demand manipulation. And it's fairly easy to identify if you've got 2 or 3 million people unemployed, that if they were employed, you could produce more. So you can see a YF, Y full employment, to the right of YE. And you could shift either the withdrawals or injections curve to create a crossing point, if you like, a point of equilibrium, between Y and E at YF. The obvious one, which Keynesians would always push to close an output gap, would be increase government spending, don't increase taxation, but increase a borrowing requirement and shift J vertically upwards. If you shift J vertically upwards, you then would shift it far enough to create an equilibrium. At YF, you could close the output gap, you could get full employment. It's nice and simple, should work in theory. Unfortunately, it doesn't work in practice, but should work in theory and gives you your income multiplier. Because your income multiplier is the change in Y along the horizontal axis divided by the change in J. And the multipliers, Keynesian, is given the symbol K. So if I wanted to increase Y to YF by 300, and I know the multiplier is 3, all I'd have to do is put 100 into the economy, and 100 would increase the output of the economy from YE to YF. There's an algebraic formulation of the slope of that line, which would be related to the marginal propensities to save, pay taxes and buy products from abroad, and the slope of that line is an algebraic formulation which is 1 over the marginal propensity to withdraw from the circular flow, the marginal propensity to save tax and import when there's a change in injections or withdrawals into or out of that flow. That is what the income multiplier is. It's a flow concept. It's not a stock concept. The money multiplier is a stock concept, but this is a flow concept. But of course, this process could and usually does require an increase in monetary demand. So if I was shifting J to J1 by the government spending more money, the government spending more money is expansionary in what's described a fiscal sense, but also in a monetary sense if any or all of that is financed by an expansion in the money supply. So there's similar concepts, but I hope you will understand just a little about why you should see them as being different from each other, not the same. Now there are among economists a lot of discussion about these things. There are 2 interventionist schools of thought which I'll mention now, one going out of favour and the other coming into favour, which is going out of favour of the Keynesians, but coming in are the modern monetary theorists. And they have make very similar assumptions to Keynesians. Keynesians assumed there were output gaps that you could close, as I just illustrated, and they assumed that if you stimulate demand within the economy, you could move from a position that they called under full employment to full employment. And they would do this by budgeting for deficits in the economy. The modern monetary theorists, they have exactly the same idea. They have the assumption that there are output gaps that can be closed by manipulating demand, but they don't like the original idea of the Keynesians, which is illustrated there. I don't want to give you too many of these because it's going to become confusing, but the red line is this, what's thought of as an economic cycle, a trade cycle that takes place when governments don't do anything. The economy is thought to go up and down through booms into depressions when the economy is not managed by a government. And what Keynes said in the general theory of employment, interest and money, and got Keynesian economists excited, was that you should deal with boom and depression in the very opposite way to the way it would be dealt with in the marketplace, if you like, without any government intervention. Because during a boom, economies would be growing, incomes would be growing, employment would be increasing, governments would get more revenues, governments would spend more money and accelerate the boom. During recessions, unemployment would rise, people would become unemployed, incomes would fall, government taxation would fall, they'd spend less. So Keynes argued they were just reinforcing that shape. He said do the opposite. When economies are booming, take some money out of the economy by running a budget surplus, getting taxation to be greater than expenditure. And when the economy was in a depression, budget for a deficit, do the opposite again and expand government spending and cut or keep taxation at the same level, so that you would sort of reduce the amplitude of this cycle by doing the very opposite of what is happening in the economy. That's managing the economy. They like Keynesians to call it like a thermostat in the economy, which would keep the economy at the same temperature by them adjusting the heat up and down. When the economy is overheating towards a boom, then they would take the temperature down, and when the economy was getting cold, they would turn the temperature up and push the money back. Now that was the Keynesian way of trying to manage an economy. The modern monetary theories, they've got the same idea about the economy, that you get high unemployment, you can't get out of that unless you stimulate demand in some way or other. But they conflate monetary and fiscal policy. They don't use them separately. They have one expansionary policy in their mind, and they don't have a deficit surplus situation in their mind. They have a more expansionary or less expansionary, or even a stop when inflation takes off type of economy. So what they would want to do is expand monetary demand up to the point at which you reach the full employment, or you close the output gap. And they refer to government spending always as creating new money and taxation as destroying money. Keynesians see monetary policy and fiscal policy as two separate things. Fiscal policy being the central bank using its levers of interest rates and quantity changes to influence demand, and fiscal policy being the government taxing, spending and borrowing. But for modern monetary theories, these two things are brought together, and it's one of many mistakes that MMT makes is to there's a list of them on my blog. I think there are 4 mistakes fully explained, but they confuse money with income. They think they're the same thing, and of course we highlighted the fact with money multipliers and income multipliers that they're not, but they tend to think of them the same. They make mistakes over the role of money and the quantity of money in the economy. They argue that there's a natural rate of interest which should be 0, and they argue for a job guarantee scheme which is unworkable. And I do explain all of these things on my blog, but I do like to recognise the fact that for many years I argued against Keynesian economists who thought they could do these things and they couldn't, and now I have to argue against modern monetary theory that thinks that all of these things can be done in a slightly different way, but they misunderstand the way the economy really works. Both Keynesians and MMT, if you like, have main macroeconomic targets, the 4 basic ones before we talk about any additional ones to do with redistributions and environmental damage and those sorts of things. The 4 basic macroeconomic targets were full employment, low inflation, a sustainable economic growth and a satisfactory balance of payments. And both of them want active fiscal policies to do this, and they want accommodating monetary policies to do this, and there are just slight differences in the way that they think these work and they think that these would work. So they want to manipulate the economy to try and achieve some sort of full employment, non-accelerating inflation rate of unemployment and NAIRU, a balance of payments which is satisfactory, and a rate of economic growth which could be sustained over a long period of time. So that's their policy, what they think will happen, and they would be described, or be in my mind, what you would describe as interventionist economists. There are less interventionist economists, schools of thought, which are the monetarists. They're the ones who like to use the idea of the quantitative theory of money, and the Austrian economists, who are all for capitalism and free markets. And monetarists and Austrians together would be described as less interventionist. They don't see governments can do any of these things except control the average level of prices. So of all these big schemes, they would say central banks and governments should work to achieve an inflation target, which is as close to zero as possible. The targets normally set throughout the world are a 2% inflation rate at a maximum every year, and that can be done. I'll explain it in a later lecture, but that can be done. So it's possible to maintain control over inflation. And they say you can't control the level of employment in the economy, you can't create growth, governments can't create growth in the economy, manipulating demand doesn't do that. So the whole argument from monetarists is do the one thing you can do, control inflation in the economy, and there you've created the best stable prices, the best economic environment for all the other things to flourish. That will create your highest level of employment. It will create a balance on the current account of the balance of payments, and it will set off an economy to flourish under capitalism and grow. So the less interventionist economists say do one thing, control inflation. The more interventionists think they can control all of these things. So getting back into the sort of money side of things, the banking side of things, the finance side of things, and more will be explained later on. But what do I want of government and the Bank of England, central bank and the Treasury? What do I want of them to do? I want them to control the average level of prices in the economy. They can do that. They can do that fairly precisely, not absolutely precisely, but fairly precisely. So I would very much like them to do that. They've got some measure of control over the balance of payments, but it's not particularly strong control. They have very little control over the level of employment in the economy. That's determined by a lot of supply side factors. Government can change conditions on the supply side of the economy, but they cannot manipulate demand to change that in any way. They can manipulate demand actually and make the level of employment lower or the level of unemployment higher, but they can't actually change what I would describe as a natural level for employment and unemployment. And the government, because they haven't got the information or the knowledge, can do nothing to control the level of economic growth in the economy. And in general, there's a rough rule of thumb that if governments spend money, they waste money, and it's usually the case that they make things worse, not better. And don't believe a government that says we've created 100,000 jobs by spending this money, because they've probably destroyed more than 100,000 jobs by redirecting resources into an area where they have spent money less wisely than you or I or the market or the private sector would spend money. And lastly, a sort of word about, as I promised, about QE, QT and OMOs and the difference between them and the problems about them. The thing about quantitative easing and indeed quantitative tightening is that they came into a sort of new time when things were meant to be transparent. So when you quantitatively ease a central bank, it has to tell people it's done it, and if it quantitatively tightens, it tells people it's done it. hardly anybody understands what's going on with quantitative easing and quantitative tightening, and but because they're transparent, people have ideas and they think quantitative easing will do this, and it probably won't. And quantitative tightening will do that, and it probably won't. And that causes lots of problems and reactions to QE and QT. OMOs were always done secretly. Open market operations, and still are secretly done. You manage liquidity in the banking system, and you can increase the amount of cash in the system and encourage more borrowing through quantity of money changes, and it can all done through OMOs, and that was never done openly or transparently. I know the purists among you would like everything to be transparent, because the assumption is everybody understands everything and they would know what was going on. But this is one area where people don't understand what's going on, and it is actually better to carry on expansions and contractions in money in secret rather than transparently, which is why I would like a rules-based open market operations system working, and we can ignore quantitative easing and quantitative tightening. They can now be sort of brought into the area of OMOs, and therefore we won't get all the misleading descriptions of what's going on in the economy when quantitative easing takes place, or if. Well, quantitative tightening probably will never take place because it's bound to have bad press immediately. The government says that they are going to contract something, and although it might be the thing that you have to do, no one would really be able to stand up and do it and expect that they could get lots of votes by quantitative tightening. They could get lots of votes by quantitative easing, so I suspect you can all see which way that would go. So that's the end of lecture 3. I hope you've got some idea of, again, what's going on in the banking and financial sector in the economy, and we will move on to sort out some of the other areas where there are problems and look at money and banking from the point of view of efficiency. One thing we will do, hopefully you'll enjoy, will be to separate clearly what is meant by capital adequacy and liquidity. They're often misunderstood, and I've got a nice little example which will help you understand that, but I look forward to speaking to you again in the not too distant future. Thank you.